Your energy bill does not care whether sanctions worked on paper. Your fuel price does not wait for a government report to look expensive. And your grocery bill can feel a war premium without naming the war. That is the uncomfortable part of sanctions on Russia. Most people imagine sanctions like a wall. A country is cut off, payments freeze, trade stops, and pressure arrives. But money does not move through one wall. It moves through banks, ships, insurers, brokers, ports, currencies, invoices, and payment systems. So the real question is not whether sanctions make trade harder. They do. The real question is why Russian-linked money is still moving at all. Sanctions do not always stop money first. They make money pay tolls. The first toll is the discount. Research on the oil embargo and price cap found that in March 2023, Russia accepted about a $32 per barrel discount on Urals crude compared with January 2022. Nearly half of that discount came from the higher cost of shipping crude over longer distances after Russia redirected much of its oil toward India. Another $17 per barrel came from stronger Indian bargaining power. The oil did not vanish. The buyer gained more power. India could say, this cargo is harder to move, harder to finance, and harder to insure, so I want a cheaper price. That is how sanctions can hurt revenue without fully stopping trade. The oil keeps moving, but the route takes a cut. Before the disruption widened, moving Russian crude from Baltic ports to India cost around $4.7 to $4.9 million for one-way shipment. After new sanctions and tanker disruption, that same route reached about $8 million in early March 2025. That is roughly $3 million more on one voyage, not on a full year, not on the entire oil trade. One voyage. Pause on that. When people say the oil still moved, they are missing the money story. Yes, it moved, but it moved with a bigger toll attached. That extra cost sits somewhere in the freight contract, the seller's margin, the buyer's price, or the discount Russia has to accept. And then the toll became even more dramatic. In March 2026, Reuters reported Baltic to India freight rates around $22 to $23 million per vessel. That was nearly double early February rates. The value of one Urals cargo from Primorsk also jumped from about $35 million in February to around $54 million in March. At first, that sounds like Russia wins. Oil prices rise, cargo values rise, money keeps coming in. Well, not exactly, because higher tanker costs can eat into the gain before the money gets home. The headline says oil prices jumped. The money story says the route became financially heavier. This is the first major twist. Sanctions may not stop the cargo immediately, but they can make the cargo slower, riskier, less profitable, and more dependent on middlemen. Now, move from price to logistics. Energy does not travel as a political statement. It travels through steel, crews, flags, ports, tracking systems, insurance papers, and ownership documents. When mainstream shipping steps away, workaround shipping becomes valuable. That is the money logic behind the shadow fleet, and this is not a tiny loophole. In April 2026, Korea estimated that sanctioned shadow tankers carried 54% of Russia's fossil fuel export volume, the highest share on record. Korea also reported 47 shadow vessels operating under false flags. 5 of those vessels delivered about 236 million euros of Russian crude and oil products, while flying a false flag in April. This is where the story stops being abstract. Real ships, real cargo, real invoices, real money. A shadow tanker with weak insurance is not just a sanctions problem. If something goes wrong at sea, it can become a cleanup problem. If ownership is hidden, responsibility becomes harder to trace. They can move risk into places ordinary people never agreed to insure. But ships are only half the story. Even if you have the tanker, you still need to pay for the cargo. That is where the financial wall starts to crack. Every commodity trade is also a payment trade. Someone has to settle the invoice, move the currency, and decide whether the payment is safe to touch. In April 2026, the EU's 20th sanctions package targeted exactly this plumbing. It imposed transaction bans on 20 Russian banks. It also targeted four third-country financial institutions accused of helping sanctions circumvention or connecting to Russia's banking messaging system. And it went after crypto-linked routes, including platforms connected to ruble-backed stablecoin A7A5, RUBX, and support for the digital ruble. Not just barrels, banks, not just ships, settlement rails, not just ports, payment systems. Sanctions do not only attack the product, they attack the transaction that allows the product to become money. If a major bank refuses the payment, the buyer searches for another route. If one currency channel becomes risky, a smaller channel becomes useful. But smaller channels rarely offer the same speed, trust, or price. Slower money creates pressure for businesses in the middle. Working capital is survival cash a business needs while waiting to be paid. If payment takes longer, more survival cash is trapped inside the trade. If more cash is trapped, the trader demands a larger margin. So pressure aimed at Russia can squeeze private balance sheets on the way. Now imagine the global financial system as a pipe full of water. If one hole is plugged, the water does not always disappear. Sometimes it sprays out through a weaker pipe somewhere else. That weaker pipe is where shadow trade lives. Not because it is clean, because pressure has to go somewhere. Now look at the scale. In July 2025, the UK sanctioned 135 shadow fleet tankers. The British government said those tankers had carried $24 billion worth of cargo since the start of 2024. And once an alternative economy exists, every new rule creates a new map. Enforcement raises the cost of moving money. Adaptation tries to keep money moving anyway. The space between those two forces becomes the shadow trade economy. In April 2026, Russia's fossil fuel export revenues rose to about 734 million euros per day, even though export volumes fell 7%. Crude oil export revenues were about 374 million euros per day. Seaborne crude volumes dropped 24% month on month. Volumes can fall, sanctions can expand, routes can become harder, and money can still move, because prices, rerouting, freight premiums, and payment workarounds keep the system alive in a more expensive form. This does not mean sanctions failed. It means movement is the wrong measure. A company can still sell while losing margin. A ship can still sail while becoming harder to insure. A payment can still settle while becoming slower and more expensive. The better question is, who paid the toll after the clean route closed? Did Russia accept a discount? Did India gain bargaining power? Did freight companies charge more? Did shadow tankers become more valuable? Did smaller banks and crypto routes become more important? Did energy risk feed into freight, food, and household pressure? That is how a sanction story becomes a money story. A sanction becomes a discount. A discount becomes a freight premium. A freight premium becomes a financing cost. A financing cost becomes a margin problem. A margin problem becomes a price somewhere else. By the time it reaches the household, the label has disappeared. Sanctions are not a magic wall. They are a financial pressure system. They make clean money harder to move. They make risky money more expensive to move. They make middlemen more important. They turn compliance into a cost center. They turn discounts into part of the punishment. And they turn shadow routes into part of the survival mechanism. So, when someone says sanctions failed because money still moves, they may be asking the wrong question. A business can still sell while losing margin. A ship can still move while becoming harder to insure. A payment can still clear while becoming slower and more expensive. The quiet effect of sanctions is often not instant collapse. It is friction. Friction weakens trust, raises costs, rewards middlemen, and pushes trade into darker corners. And sometimes friction reaches people who were never named in the policy. That is why Russian-linked money can still move through the world. Not because the old system is untouched, but because the new system found costlier doors. The loud story is sanctions. The expensive story is friction. And in global finance, friction does not stop money first. It teaches money how much extra it must pay to keep moving.